Hi guys, in this video I'm going to cover the content of BTEC Level 3, Unit 3, a cash flow forecast, which is part of business finance. What is a cash flow forecast? A cash flow forecast is going to predict what money is going to come in and what money is going to come out of a business over a 12-month period. If a business has a healthy cash flow, it's going to mean that they're going to be able to meet their short-term money demands. And it allows the business to know where they might fall short of money so then they can try and stop this from occurring. What are cash inflows? So cash inflows is money that's coming into the business. The type of cash inflows are cash sales, credit sales, loans, capital introduced, sale of assets, and bank interest received. What are cash outflows? Cash outflow is money going out of the business. Some examples of this is cash purchase, credit purchase, purchase of assets, VAT, bank interest paid, rent, wages, salaries, and utilities. Now, what is opening and closing balance? When you look at a cash flow, you're going to see there's opening balance and there's closing balance. So what is opening balance? Opening balance is how much money a business is going to have at the start of the month. And closing balance is how much money there is at the end of the month. So for example, whatever closing balance a business has at the end of March, that's going to be how much money they have at the beginning of April. So the closing balance at the end of March will become the business's opening balance for April. Now, there are two important equations that you have to remember when you're working with cash flows. One is, how do you calculate closing balance? To calculate closing balance, you have to get your opening balance plus your cash inflows minus your cash outflows. Another important calculation is how to calculate your net cash flow. To work out net cash flow, you do your inflows minus your outflows. Let's look at an example. This is an example of a cash flow forecast. As we can see here, in March, the opening balance that a business had was £1,000. The income that they had coming in, the cash inflow, was also £1,000. That's the only income they have coming in for the months. So that's the only inflow that they have. So their total inflows is £1,000, and the total cash that they have available in that month is their opening balance plus their income, which becomes £2,000. Now, the outflows that the business had was purchases, rent, heat and light, and the total of that was £2,280. Now, to work out the closing balance, you do opening balance plus the cash inflows minus the cash outflows. Opening balance is the money available at the start of the month, and as we can see that in March, their closing balance was minus 280. Now, whenever there's a minus, that does show that the business are not able to meet their short-term cash needs. And we can see that in April, because their closing balance in March was minus 280, that's how much money there is at the beginning of April. So March closing balance is April's opening balance. Now, how do credit periods affect cash flow? The longer a business keeps their credit period, the slower the money is going to come into the business. So credit periods also affect the credit that they get from their suppliers. If they can get a longer credit period from their suppliers, then cash will leave the business slower. Now, if a business buys and sells on credit, they need to make sure that the money that is coming into the business is quicker than the money that's leaving the business. So if they have credit period for their customers, they need to make that shorter than the credit period that they get from the suppliers. That way, money comes into the business quicker than money goes out of the business. Opening and closing bank balances. The opening bank balance at the start of the year will show how much money the business has, and the closing balance will be based off predictions of the inflows and the outflows of the business. It will help show if there are any months that are at risk and they can arrange any source of finance. If a business has a negative bank balance, they have liquidity issues. Liquidity issues is showing how able a business is to meet any short-term payments. If they can't meet short-term payments, they can become insolvent. Uses of cash flow forecast. Where is a cash flow forecast used and why is it used? A cash flow forecast will help determine where the possible downfalls in the business might be regarding money. It also helps the business see how much cash they have left at the end of the month. If they have a high amount of cash left over, it might also mean that the business is not using their money to the best of their ability. A cash flow forecast can be used to compare whether the business is doing better or worse than they expected. Problems that can occur with a cash flow forecast. One of the problems is that the money going out of the business is more than the money coming into the business, which could then affect liquidity issues. Some businesses might have inconsistent cash flows, so there will be times of the year where they might be really busy and then time of the year where they might be less busy. Here are some solutions that they can have to solve cash flow problems. One is they can arrange an overdraft for when there might be a shortfall of cash in the business. The businesses can negotiate longer periods with their suppliers if they're able to, and review money that the business is spending and see whether it is necessary payment to make or can that payment that they need to make be postponed to later on. Here are some advantages and disadvantages of a cash flow forecast. Some advantages of cash flow forecast is that it encourages planning. It allows money coming in and out of the business to be monitored. So here are some of the disadvantages of cash flow forecast. One is the forecast is predicted, so it can be inaccurate. It cannot plan for unexpected costs, and it's time consuming to produce a cash flow forecast. Here are some practice questions that you can pause and practice on to test your knowledge. If you like this video, then give it a like. If you want more updates on new videos and resources, then you can follow my Instagram. And you can also find resources for this video on my test shop.